Hi everyone, just wanted to record a quick overview of the main financial statements and how they link together. So I've got the three financial statements here, the income statement on the left, or the statement of profit and loss, or the statement of financial performance, all mean the same thing. It shows financial performance over a period of time. Starts off with revenues, then deducts various types of expenses. Typically we'll start off with cost of sales. Revenues less cost of sales gives us gross profit. We then deduct operating expenses, so selling, general admin expenses, depreciation and amortization. That gets us operating profits, which you'll often hear described as EBIT, earnings before interest and tax. We then deduct finance expenses, and that gives us a profit before tax. Deduct tax expense, and that gives us our net profit after tax figure. So that's going down the income statement. So net profit after tax is bottom line earnings. I'll come back to that in a second. The balance sheet shows us the resources that the organisation has, the assets, the way in which they've been funded, be it liabilities or owner's equity. And we know that the assets must balance the liabilities and owner's equity at all times. That's the accounting equation. The resources could include things like cash, receivables, inventory, property, plant and equipment, intangible assets. The liabilities could include things like payables, loans. Owner's equity could include things like the contributed capital and retained profits. And it's the retained profits is the link between the income statement and the balance sheet, because retained profits captures everything that happens in the income statement. So retained profits at the end of the year is retained profits at the start of the year plus net profit after tax less any dividends. So that's the link between the balance sheet and the income statement. The cash flow statement captures in its whole the changes in the cash account on the balance sheet. It separates those out into operating, it's the day-to-day operations of the business, so collections from customers, payments to suppliers. The cash flow from investing activities, which typically refers to the purchase and sale of the non-current assets. So on our little example here, the investing cash flows would relate to our property, plant and equipment and intangibles. The financing cash flows relate to the way in which the business has been funded. So raising equity capital, paying back equity capital, borrowing and paying back borrowings is all going to be part of the financing activities. If we're thinking about the way the cash flow statement and the income statement work together, that's where we think about our accruals. Because the difference between the income statement and the cash flow statement comes down to when we're receiving cash versus when we're recognizing revenue. So I can quickly set this out. Standard retail operation, we can receive cash in the same time period as we recognize revenue. A customer comes in, buys something, pays us. So cash is received at the same time as the revenue. In some cases, cash is received before the revenue. Let's think about a situation where we're running an airline. Our customers will typically pay us for the airline ticket before we fly them. So the cash comes in, and that's matched by what we'll call unearned revenue. So that's a liability on the part of our business because you can't recognize revenue until you have done what you need to do. So that is, in the case of an airlines, until you have flown the customer. Sometimes cash comes in after the associated revenue. That's where the customer pays us on an invoice. So that's where we'd get a receivables coming up. So cash can be paid before, during, or in the period after the associated revenue was recognized. The same thing happens for expenses. We can pay cash in the same period that the expense is incurred, or we can pay cash beforehand, or we can pay cash after the associated expense. So if we pay for the expense before it is actually incurred, that's where we get a prepayment. So prepayment in advance, or we've got a deferred expense if we're paying the cash afterwards.